Welcome to the daily update, where I'll go over the action in the market for Wednesday, November 12th, and we'll see how things look for Thursday, November 13th. Well, kind of a sleepy day as far as price action. We're still seeing this defensive tilt in the market where growth is underperforming. Mega caps didn't really have a very good day, and the market is just kind of shifting like it's getting ready to either continue to go sideways or go down. Now, we did see one change. We're switching over to the positive default with our trend indicator, the ADX. The green line crossed above the red line, both in the short and intermediate term. So now we default to positive, but we're still not trending. We're still below the moving average. We're still going down. And so what I've been doing and recommending are more market neutral types of strategies where they're not trend based. We just try to stay within a range and take advantage of market conditions that way. So, before I get into the video though, please be aware that I have a thing called the SPX investing program where I make recommendations, just suggestions. I'm not a guru. I don't tell people what to do. I don't say buy at this price, sell at that price. I just say, okay, this is what we're looking like right now. And now you can take that, agree with parts, disagree with parts, and then turn that into your own strategy. I know that's different than most people out there, and I really base things around critical thinking and just saying, okay, let's take all the information we can and reach a conclusion. And we may not always reach the same conclusion every time. But if you want to access the program, here is the link. It's also right below the video, both on YouTube and Rumble, to take advantage of that. And there's two parts of the website. One, you get full access to everything, but you have to provide payment information. The other part is there's another website that I built where you don't get quite all the information, but you don't have to provide any payment information. So feel free to check that out. Okay, and it's free until the end of 2025. Right at the open, we did have a higher open, and prices set the intraday high right there at R1 68.66. Then we declined. We actually went negative below the unchanged level. We found support at the daily pivot at 68.36. Then we just chopped them above and below the unchanged level. So we bounced up a little bit from the daily pivot after sitting there for a while, and we closed slightly positive. So we were just up 0.06%, virtually an unchanged day as far as the index is concerned, and we were below average with volume. And we're still positive though. We're above the 20, 50, and 200-day moving averages. That's what I use to measure whether we're positive or negative in the bigger picture. And then we use all these other indicators to say, okay, are we leaning more positive or are we leaning more negative? And we did see interest rates come down, so that probably helped the market to at least not change all that much by the time we closed. And now the big news is right about the time I'm recording this, the president has signed the bill or piece of paper, or whatever you want to call it. Now the government shutdown is done. So it worked its way through the Senate, then the House. Now the government's back open. We'll have to see what all that means. I checked the futures right before I started recording. Not much of a change there. A lot of this has already been built in. That came out last week and then over the weekend, and that was helping things to look like the shutdown was going to be over. But according to what's just come out, we're going to be right back here at the end of January. So it's like enjoy it while you can, and then we'll go through the next round when we start into 2026. So, some comments. The Dow did set another new all-time high, and it's seeing some favor these days and performing a little bit better than some of the other indexes. And mega caps and growth did underperform. Now, semis were okay, but not mega caps and growth. We're the broad market, and a lot of the broad market is more value and more defensive, and that's why we're seeing a lot of this build up, and we're seeing a lot of a tilt more to the value side rather than the growth side. What we want to see is everything going up at the same time. We see the broad market doing well, and then the mega caps even outperforming more than that. That's when the market is really strong, and we're not really seeing that right now. Oil prices did decline. OPEC came out and said that they expect global oil supply to match demand by 2026. And they recently said that there was going to be a supply deficit or a demand increase. And so that's pushing oil prices down a little bit. And the government shutdown appears to be over for now. I did this point here before I actually heard that the president signed the government shutdown piece of paper there. Now it does look like it is, in fact, over. And then we had some Fed speak. Raphael Bostic, who's not a voting member, reiterated that inflation remains a greater concern than the labor market and supports holding rates steady until the 2% target. We've been waiting now for what, 2, 3 years for this inflation rate to get down to 2%, and it's stubborn at just under 3%, or right around the 3% level. And also, Mr. Bostic announced that he will retire once we get through the February in 2026. All right. National Economic Council Director Kevin Hassett said that he believes rates could be a lot lower. Well, you think somebody's lobbying for a Fed position here or an FOMC position? But he did add that he would accept the nomination if it was offered by President Trump. Okay. So yeah, let's say some nice things and maybe I'll get on the committee. And there, we still have a confirmed Hindenburg moment. We don't have another spike. We're still going off of the spikes that have been generated over the last week or so, and even last couple of weeks. So we just want to respect that. And that's not a good sign, but I don't declare everything right now. It's like sell everything, go short. No, no, no. We wait and look at all the other charts to see, okay, is that actually playing out? Are we seeing follow through? We don't just base everything right around one, two, or maybe even three indicators. I learned that very early on in close to 40 years of being involved in the markets that the big pushback against the way I approach technical analysis is, well, they say it's just analysis paralysis. You're looking at this, you're looking at that, and you're never able to make a decision. No, I don't approach it that way. I use a consensus approach. I have some main indicators that we look at, and then we look at other things as well, and then tie it all together. And that's served me personally quite well, and my students quite well over the years. And so I don't just look at the Hindenburg Allman where you just say, okay, this is the one thing we're basing everything on right now, and I'm making all my decisions on that. I don't do it that way. All right, and no change to the overall scenario other than what was said in some Fed comments earlier. The dollar was up. We're still below that 100 level with the US dollar index, and interest rates were down. We're at 4.07%. We're improving again now as far as sentiment. Now, the number again is 34. That's negative if you look at the number in isolation. But if you look at the context, we have been improving where we were at 31. And we're still not trending, but now instead of defaulting to the negative side, we're defaulting to the positive side. I'll show you these charts. I kind of already explained that. And with the slight up day and the slight up day the day before, we're looking positive for the bias. And I'm still keeping the momentum at mixed to positive. Yeah, we're positive in some aspects, but we're mixed because we're not really seeing the offensive stocks really moving the market right now. And we're still not trending in the short term either. We did get just one lowly little economic report. We like to look at this. It's not a major report. It doesn't move the markets. It just gives us an idea of what's happening with mortgages. And excuse me, and we were up 0.6% this week. We were down 1.9%. You break that out, the purchase index was up 5.8%. The refinance index was down 3.4. And here is a look at that chart. This is just the main number. It doesn't break it down into the different areas, but slightly positive there after it had been negative. Okay, then change in liquidity against the S&P. Now you look at the liquidity index, that's the red line, and when this is going up, that tends to really help the market go up. And even when it's kind of going sideways, the market can go up, and we've been going sideways here. Well, we're seeing a real disconnect right now. Is this going to put some pressure on the market as the liquidity index has been coming down? And this is I was showing these all the time back in 2023 and 2024. They would have which days of the week were positive and which were negative, and we saw the Monday carry over in, excuse me, the Friday carry over into Monday. That was the strongest part of the market because people would make decisions over the weekend and buy, and based on the update that we had on Friday. And that's still working to a degree. It's the second best day of the week is Monday. Tuesday is kind of ho-hum. Wednesday tends to be the most positive day in 2025. But then as we get later in the week, Thursday and Friday, that's where we start to see more negative returns, at least in 2025. So this does shift over a period of time. And risk appetite, positive here, going up here, where folks are willing to assume more risk over the next 30 days and slow down a little bit here. But also, folks are thinking that the market is going to actually go up over the next 30 days based on this chart. Mega cap growth, that's still where most of the money is going, as well as tech. Those are big areas of the market. And so they're above the average here. They're also above zero. That's where people still want to put their money. And then exposure to gold has dropped off a little bit here. These are the commodity trading advisors. And since we've seen a bit of a pullback, even though gold's been holding up okay, and it's possibly going to go sideways for a while, I don't know. I don't follow it that close. But we have seen some money coming out, but there's still more money going in. So we're above the zero level here as far as having exposure to gold. And then equity risk premiums. This is just giving us a really low reading right now. Now we have another chart that we look at later on that I use more like a sentiment gauge. But when we're down below this zero level, that just means that, okay, we're taking on a lot more risk to own stocks, but we want to be compensated for that. And when we're getting high readings here, that means, okay, yeah, risk versus reward. You're throwing your money into stocks. There's more risk behind that, but the return potential and the return results have been greater. Well, this is showing now it's like, okay, people are buying stock, but they're not necessarily being rewarded for taking on that additional risk. And then here we get this every other day, if not every day here, just showing how we're overvalued with the S&P at 23 with the PE ratio. We're above that 20 level. Then you have tech, discretionary, and industrials that are even more overvalued than that. We still have communication and staples, which are over the 20 level. And then once we get below 20, this is where we get into the more fairly valued area with energy and financials being more fairly priced. Then gold is now performing neck and neck with the S&P in the fiat money era. Fiat means there's nothing backing currencies, and that's what the major world currencies now have. We used to back our currency by gold. We don't do that anymore. It's just, well, trust us. The full faith and credit of the US government and then other governments in other countries. That's what fiat is here. And so they're starting to more match up with each other. And then this is like a rate of change looking back over the 52-week market breadth, where we're coming down. We're actually looking more negative here when you look at this in a bigger picture type sense. Now, I follow this on a day in and day out basis, but sometimes it can be helpful to look at this. And then rent growth is actually going down here a little bit. And then AI and jobs, this is also showing how things are falling a little bit. Is AI the cause of labor market weakness? Then why have employment rates been getting weaker and weaker for non-college youth? This is a cyclical slowdown, not an AI-driven slowdown. And there could be some truth in that. The economy built around Keynesian economics, it means we have cycles. We have really big growth cycles, we have retraction cycles, we have positive cycles, we have negative cycles. And this is showing, at least based on this chart, that we are now going down. But the hope is that at some point we'll start to go back up. This is kind of a convoluted chart here. It's like they got all these little dots all over here. I don't like these dot plot type charts. That's why I usually don't show them all that much. And this person here, an economist, says we are seeing emergent signs that AI is driving business formations. Well, yeah, okay. We also think that the worst for firm birth death model is over. Okay, so you have a new company, doesn't make it, so they die. As long as the Fed is willing, I like Marty Daly's framing. Well, I don't know who that is. What the Fed decides to do could either fan or choke a 90s style productivity. They're trying to draw a lot of parallels between what's happening now in AI with what happened in the dot-com boom and bust in the late 90s. And yeah, you can make some comparisons there. But to just say this is an apples to apples comparison, I don't think is the right way to do it. There are differences, and we're seeing some areas that will likely be bubbles, other areas that will survive and end up leading the way. So this trend could continue, and we see more sustained labor productivity in the next year. Okay, so I guess that's the takeaway. And then they got a whole lot of stuff down here at the bottom. But if you want to pause this and read through this, check that out as well. Healthcare rally. Now, healthcare's been doing pretty well lately. Now, part of that is because it's been so beaten down, and these companies they're having fairly good earnings reports, and there's been some news coming out that's more favorable for the healthcare sector as a whole. And so you combine those things, and that we're seeing it's one of the best performing areas right now. It still has a ways to go to start outperforming the S&P, but you have a lot of the bottom feeder folks that are trying to get in early riding this wave. That's the positive side of things. Now the negative side is healthcare is defensive. And so if that's going to be an area that's going to see more favor, that's what the market gets into when it does switch from being growth oriented to more defensive oriented. And it's been doing pretty well lately. And I go over that in the weekend videos, especially the intermarket analysis video. Then here's another equity risk premium. These negative risk premium charts circulating again. People are talking about this here. Reminder, stocks are real assets. Earnings per share, dividends demonstrated they grow with inflation over time. Earnings yields and tips are the right comparison. Risk premiums, roughly half last 20 years. Okay, the rule of 72. If you want, I read through this and I'm like, okay, I'm not sure really what they're saying. We're just seeing this number going down almost altogether here. Okay, so let's go into our charts. Now, all these other charts that I showed before this, I don't make these, so I don't know a lot of the thinking and the story, the deeper story that some of these charts are trying to say. That's why I go through these first, get them out of the way, and then we go through the charts that we look at pretty much every day here. So we did have a higher open, but we set the high right at the open, and then we drifted down below the unchanged level. We were able to find some support after hanging out at the daily pivot for quite a while. We got back above the unchanged level, then we went negative, then we went positive, and then we just were virtually unchanged by the time we closed. And not much of a change in the initial overnight session here. The futures were up like 0.1% or something. We're not seeing this big gap up after the government shutdown seems to be done here. And again, I changed this up a couple of days ago here to give us a little longer look. We are still seeing both the red line and the blue line going up, but we're seeing the red line really going up as the blue line's just kind of not doing all that much. It's not really going down, but it's not outperforming. We would like to see the blue line above the red line, meaning that growth is outperforming value. And I had to relabel this, and I have these inverted, so I'll change that. Sorry, but the growth should be blue and value is red. So sorry about that. And see here, or our intraday growth to value chart for the S&P. It was down, just not really doing all that well, and we're below the moving averages, and we're just going back into the range where we were going back into September. All right, so growth was down where value was up for the large caps. They were about even with the mid caps, and growth was down for the small caps where value was slightly higher. So not really seeing much of a change in the small cap growth to value ratio, just kind of chopping around, but it's still looking pretty positive here, but we're just not seeing the index do all that much. But we are seeing some weakness now. We're dropping below the 200-day moving average with mid cap growth to value and a little bit into the rainbow here, but still looking positive overall with this growth to value ratio and still below the 200-day moving average with S&P growth to value. We want to see this kind of a move up like we saw up out of the April lows, and that really drove the market higher. And we just started drifting down below the 50-day moving average, and now we're below the 200-day moving average. And not seeing much of a change here. We're still below the 50-period moving average with the discretionary to staples ratio as well. And so last week, we were starting to develop into a negative trend. Well, then we had some up days, and that shifted the ADX and kind of confused it. It was starting to go up, but now it's going down below the moving average. So we're still seeing a non-trending environment, but now the green line is above the red line. So the short term has now switched to positive. And the same thing here with the intermediate term, going down with the ADX below the moving average, below 20, but now defaulting to positive. And we're dropping off here with volume. We continue to be below average there. And then here is the gamma exposure chart. We're still going to be watching that 6,800 level here. We're about 50 points above it now. If we drop below there and close below that, that's going to turn things more negative. As long as we can stay above that, and we closed right around here at the 6,850 level in Wednesday session here. And so we're still leaning more positive overall with this chart. We do have some more overhead resistance at the 6,900 level if we start going higher. We did get the latest reading from Investors Intelligence. We're dropping down. We had spent the last 2 weeks above 4 and we topped out. Now we're starting to drop down below 4 at 3.75. So that's coming down a little bit now. Still above the moving average with the Ulcer Index, still inside the moving averages here with the VIX, but we're below 20. That's the positive takeaway. We're more into the mid 17s now, both with the line chart and the bar chart. And we did see a little bit of a pickup though with the volatility of the VIX. It's starting to move a little bit more here. We're above the moving average with the bar chart and line chart. So we ticked up here with this fear gauge and we ticked down with this other fear gauge. So not a real confirmation there. We saw a bit of a drop off with the daily equity put call chart. So we're starting to go back down. We've been really choppy here with the 5-day chart where we're continuing to go up with the 10-day chart. And this is another thing I've been noticing over the last few trading sessions. We're seeing momentum stocks, which would be your growth stocks, the stocks that you want to buy low and sell high. They continue to underperform the S&P on a ratio basis here. So this is a little bit of a concern to us. We're seeing this kind of feeds into this more defensive posture that the market is now taking. And here, this is the volatility risk premium here that we follow, and we're just at the upper end of the band, and we've been going sideways. So still doing okay, but not at new highs yet with the advanced decline line based on price and volume, but they both did advance. And we're above the midpoint with the advanced decline ratio. We're above zero with the advanced decline oscillator. We are improving. We're seeing a breakout of new highs because these are the rest of the stocks in the S&P anyway that are now starting to see some favor, even though the mega caps have been taking a bit of a back seat. But since there are more stocks in the broad index, that's why we're seeing more of an expansion of the new highs and really not very many new lows here. And so now our 5-day chart and our 10-day chart are turning back up. And so that is positive. And we're positive with our three smart money indicators. We're above the moving average with accumulation distribution, above the moving average with the boom indicator, even though it was pretty much flat. And we're still positive with the Chaikin money flow, and we're positive with the Chaikin oscillator. So that is looking fairly positive. Smart money is doing some buying. They're just not necessarily buying growth. They're buying value. And we are positive here, even though we tick down a bit with the vortex. The green is above the red. And we're improving with the advanced decline line studies. We're getting back above the moving averages here with the NYSE common stock. We've been improving a little bit more with the S&P, barely above the moving average with the mid caps and pretty much on the moving average with the small caps. And we're above 50 with those stocks that are inside the S&P above their 20-period moving average. So that's improving in the shorter term. We're back above 50 and climbing with the 50-period moving average study, the 100-period moving average study, and the 200-period moving average study. So that's showing some internal strength as the rest of the S&P is seeing more favor. And here's our daily chart. We still are holding out above this pivot point. If we really start to drop, that might act as support here, but we're well above that right now. We're well above the 50-day moving average. So far it looks like we're trying to come up out of this bounce. Are we going to be able to see some kind of follow through here? But we're continuing to go up on a decrease in volume. And so a bit of an improvement with the 20, 50, and 200 moving average study. We're slightly above the midpoint with the Stochk RSI. We're above the midpoint and improving, but not showing positive conviction here with the Williams percent R. We're above the midpoint with the CCI 14 and CCI 20 charts. Not really anything extreme, looking a little more positive with the short term stochastic. It's above the midpoint and going up. We are improving with the intermediate short term, and we're trying to turn up, but not quite above the moving average with the long short term stochastic. Still positive and above the midpoint with the force index. We are still above the 10, 20, and 30 moving averages, so that is looking more positive. And we're going back up with the moving average study here based on 20 periods. The blue line and the green line are going up, and we're above the simple and exponential 20 period moving averages. That's positive. And we're still up at the high end of the +1 channel with the standard deviations chart. And we actually dropped a little bit below the midpoint with the balance of power. We've been chopping right around a little bit above, a little bit below for most of November. Positive with the go, no go. The darker blue bars were above the midpoint with the highest high, lowest low value charts. Now, this, I didn't show this in yesterday's video because it wasn't registering anything. Now it's rethinking. It gave up on this trend that we had been in going back to the beginning of May, took a couple of days off, and now we're starting, you can barely see it, but the screen down here, we're starting to see the resumption of the uptrend according to the Landry Light chart. And we continue to be positive with the proper order uptrend, but we continue to decline with the TTM squeeze, darker blue and declining. That's actually negative, barely above zero with the ease of movement. The Arun's been on vacation, and we're above zero and going up here with the McClellan oscillator for the S&P. So that's positive. So we're going up with the summation index based on price and volume. Tick down a little bit, but we're still above zero with the NYSE McClellan oscillator, but we're ticking up based on price and volume for the summation index for the NYSE. This has been positive pretty much for the last week and a half or so. The swing and trading oscillator based on price and volume are both positive and advancing. Trying to improve with the momentum, but we haven't crossed above the moving average with the PMO. We're starting to cross above the moving average here when we break it out based on price and volume. So we're seeing a bit of an improvement above 50 with the PMOs that are rising, and we're just barely below 50. We're at 49 right now with the number of buy signals in the S&P on a percentage basis. We're starting to turn back up with the PMOs that are above zero. Still positive with the Elder's Impulse system, but we're still negative with the parabolic SAR. We haven't seen enough of an upward move yet to put a dot underneath price. It's still on top, and that is negative. And we're still negative here with the slope oscillator, declining below the moving average, trying to turn up, but still below the moving average with the MACD. And so we're drifting and trying to get a little more positive here, but we haven't switched over to positive. So we're still negative overall, but improving, but we're still declining here with the two long-term oscillators, and we're still negative with the Copic curve oscillator. Pretty much flat, but still looking positive overall with the Sean trend meter, above 50 with the money flow and ultimate oscillator, and on balance volume is still positive. Still looking okay with the short and intermediate term RSI. We did see an improvement here, and this is the rest of the S&P seeing some buying. So some point and figure buy signals are being generated in the S&P, even though it didn't move all that much. So we're above the moving average and going up, and we're right at 50 currently. And we're above 50 and advancing with the NYSE bullish percent index. We are improving with the NASDAQ 100 bullish percent index, but we're still below 50. And then the intermediate term trend, we're still trying to go up here with the blue line and the red line. So that's still holding up for right now. We're above all of the moving averages here. That's positive for all the time frames. And we're still more than 10% above the 200-day simple moving average. We're at 11.55% above that moving average there. Still looking okay here with our longer term weekly S&P chart. And we're up 1.81% so far on the week. So we're looking back to positive now with the Heiken Ashi, with the open candles. We're red, that's negative, but we're pointing up with the Kegi chart. We're still negative with the Renko chart and the three-line break chart. So getting a mixed picture there when we compare these four charts. Long term, we are seeing an improvement with the 150 and 200-day moving average studies there. Positive on all time frames, according to stockcharts.com, with all the different indexes. And everything's positive across the different assets except the long-term trend for the dollar. And then here we see healthcare, financial. We like that that did better. I stopped showing that chart later on because we were just seeing the same thing day after day. Tech was up, but then we see things like this communication was down, discretionary was down. We did see real estate and energy take a bit of a hit, and staples were down slightly. So started off fairly positive right after the open. We had a new 52-week high with healthcare. The Dow set a new all-time high. And then Staples had a bullish MACD crossover as well as a BPI cross above 20. It's been getting hit pretty hard lately, and that going up could be more defensive. And then real estate had a MACD crossover. We got above 23.5 with the NASDAQ and then came down to 23.4, 23.3. Canada set another new all-time high. The euro's seeing some strength when compared to the dollar. And we had a BPI cross above 50 with the financial sector, which would be good if that could continue. So not a lot of real changes here with our big growth areas. We had both Amazon and Tesla down. That hurt the discretionary area. Both Google stocks were down with communication as well as Meta. But you see here, healthcare, a lot of green. Few areas of red, but the smaller companies there. But the big companies are showing some strength currently. And we're still going up and setting another new all-time high with the Dow. We'll see if it continues to go up. Is this R1 pivot point going to act as overhead resistance? Positive with the Elder's Impulse system, and we're holding its support here. Now, for 2 days now, we had the Dow setting new all-time highs, but the Nasdaq and Nasdaq 100 were actually down a little bit. But we're holding above this pivot point for right now. So that support level is holding, but we're neutral with the Elder's Impulse system. We're also seeing support holding here with the NASDAQ 100, but we're still positive with the Elder's Impulse system for the Qs. Momentum is still negative though for the NASDAQ 100. We're still hanging out above the 20 period moving average with the Qs, so that support is still holding. And we were virtually unchanged here. We were looking pretty good with small caps, and then they gave back a lot of their gains. Pretty much still range bound when we look at the S&P 600 small cap index, and back down a little bit above the 50-day moving average with the Russell 2000 small caps. Neutral with the Elder's Impulse system. Mid caps hanging out slightly above their 50-day moving average, but still positive with the Elder's Impulse system. The Wilshire still hanging out above its 50-day moving average, as is the total U.S. stock ETF. Still above the 50-day moving average with the FANG index. And we look at the bigger stocks here. Apple was down almost 2%, just kind of chopping around lately. And Amazon was down almost 2%. Apple was down 0.65% after seeing a nice run up there. Still below the 50-day moving average with Microsoft. Still declining below the 200-day moving average with Meta. And Google still looking pretty good. It was down 1.58%, but it's been performing better as of late. Nvidia was up 1/3% and still above its 50-day moving average. Tesla coming back down. It fell over 2%, back down to its 50-day moving average there. And Netflix seeing a little bit of a surge above its 200-day moving average. And then this is the other thing that we're looking at. It's positive on one hand but negative on another. This is the Dow Jones Semiconductor Index. Now it's good because we're green and we're well above the 200-day simple moving average, but we're more than 100% above it. And so this is where we get a little bit concerned. Now, this is a weekly chart, not a daily chart. This is when we get above this 100% level, that's quite often where we see more meaningful pullbacks. We don't know if that's going to happen. We've been above this level now for quite some time, and no meaningful pullback has developed yet. So we'll have to see if that's going to eventually feed into something. And oil dropped on that OPEC news there. We're getting down into the 58 range now. And still below 100 here with the US dollar index, even though it was up slightly. And we were down with the 10-year based on the yield. We were up with the 10-year based on price. And not really seeing really much improvement, actually some weakness with our different growth to value ratios. The Qs to S&P below the moving average. Discretionary to the S&P below the moving average, and the moving average is declining. And large cap growth to value below the moving average. That's not a real offensive market. That's more of a defensive market. So we're below the moving average with the large caps really looking weak here with the mid caps still above an advancing moving average, but chopping around when we look at the large cap growth to value ratio here. And then our latest edition of the Hindenburg Omen. We don't have another spike, but we do have a series of spikes after the initial one. So we just want to pay attention to that. Just because these single spikes don't necessarily mean all that much. We watch them, and then if they go away, they go away. But when we see a series of spikes, like right at the end, the COVID crash here, the end of 2021, so just want to be aware of that. All right. So the outlook then is we're positive on all time frames. Now, who knows what's really going to come out? I mean, the government just opened like an hour ago as I record this, so if even that long. So we don't know what's going to be released. We're supposed to get initial and continuing claims as well as CPI and the Treasury budget as well. And this I did update. The government shutdown is now over, at least for the time being, to get us into 2026. And then we'll just see how things kind of play out here. Just a lot of stuff going on, but the market again is its own little world here, and it may not pay attention to what's happening necessarily on Main Street. It's more concerned about Wall Street. And then again, we'll see what comes out as far as the economic reports, this economic report calendar as well. Now, seasonality for the Dow and Nasdaq, we are positive, and we're neutral to positive for the S&P for November 13th, going back to 2002. And this is where we see typically some positive action here during post-year elections for not only the green dash line, which is the S&P, but the other indexes as well. But it can be a little bit choppy before we see a bit of a drop off here. And November is supposed to be good seasonality wise here. This also shows positive seasonality going into the end of the year, as does this chart. We're possibly getting beyond this post rate cut time now, where quite often we see positive action happening after that. And this also shows positive seasonality, as does this chart. So you can have all the positive seasonality charts you want, but we still have to follow what's actually happening here. And this also shows positive seasonality for November. So the warning signs, we're still looking more negative in the short term with our growth to value ratios. The bigger picture, now we're going to lose the bigger picture if these things don't pick up and start to show some improvement. But right now, in the bigger picture, they're positive. In the shorter picture, they are negative, or the smaller picture, I should say. Parabolic SAR is negative, and we're still negative overall with our oscillators, but they are improving, at least some of them. And the bullish percent index is still below 50. Now it's going up, but it's negative because it's below 50. And the momentum for the NASDAQ 100 continues to be negative, and we still are watching the Hindenburg omen here. And on the positive side, we have our three smart money indicators. They're positive for the time being. And we're still positive with the McClellan oscillator and summation indexes for the S&P and NYSE. And this is where the longer term, the growth to value, discretionary to staples ratios are positive. Ease of movement just barely above zero. Swell trending oscillators actually been consistently positive over the last week to week and a half. And we're positive with the bullish percent index for the S&P. We're above the moving average and advancing. We're above 50 with the NYSE. Ultimate Oscillator, Money Flow, and Vortex are positive. And I'm not going to show this chart until something substantially changes. I will go over it in the weekend video. I deal with that in the intermarket analysis video. But the financial sector is positive, but it continues to underperform the S&P. And then a chart I don't show typically in the daily videos because we don't get very many signals is the long-term daily special K chart. And the weekly chart is also positive. So here are the pivot points for Thursday's session. So our conclusion, really haven't changed anything here. We're positive, and I'm still treating this as negative momentum improving. I could say positive momentum building, but since it's more defensive in nature, I'm still kind of leaning more to the negative side, even though we're positive since we're above the 20 period moving averages, but we're not trending. And kind of a similar story here. We're not trending in the intermediate term, but we're positive. The weakness is showing some improvement there. And we are positive in the long term, but we're again more than 10% above the 200-day simple moving average. Thank you. I hope you have a wonderful day, and I will talk to you in the next video.